Welcome to episode 6 of the Cash Flow Connections podcast. The topic for today is investing with the sharks of commercial real estate. Most of the time when investors get started, they're usually drawn to investing in residential. There's a lot of reasons for this. One of them is that the barrier for entry is not that high. Almost anyone can invest in residential real estate if they've saved up some money to invest. However, there's a lot of problems with that strategy. One of them being there's not a lot of barriers to entry, so it's very competitive. We're going to talk about that a little bit today. We're also going to talk about why both our guest and I like to invest in sophisticated individuals in complex properties where there's a lot of value add potential as opposed to something more cut and dry like single family investments. We're also going to talk about market selection. What are the differences between tier 1, tier 2, and tier 3 cities, and where is the real opportunity out there? And as you may tell by our guest's accent, we're going to talk about the differences between investing here in the United States as opposed to Australia. Now, before we get to the interview, I just want to take a second and thank you very much if you provided some positive feedback recently. I have gotten a lot of positive feedback and it means a lot. It's great to hear that we're actually providing a ton of great, valuable content out there that is educating new investors and seasoned veterans. So the only thing that we ask in return, though, is to take 2 minutes and rate us on iTunes. The more ratings we get, the better visibility we have and the better quality guests we're going to continue to be able to bring you. So if you would just do us a favor, go to the podcast app on iTunes and search for Cash Flow Connections and give us a reasonable rating, aka wink wink, 5 stars would be super appreciated. Let's get straight to the interview. How's it going, everyone? Today our guest is Reed Goossens, who is the founder of RSN Property Group. Reed is a serial real estate entrepreneur who moved from Australia to the United States in order to pursue his real estate investment career. His experience includes project management, property development, and syndicating commercial real estate projects. He's been involved in more than $500 million worth of real estate transactions across several different continents. Over the last several years, Reed has developed a personal portfolio of solid cash flow investment properties, and he also has a background as a qualified structural engineer. So Reed, really excited about this conversation. Thanks a lot for coming on the program today.
G'day, Hunter. How's it going, mate? Thanks for having me.
Absolutely. So before we really jump into the details of this discussion, let's talk a little bit about your background prior to beginning your real estate career, and then discuss how you really got interested in real estate in the first place.
Sure thing. I love talking about my story. Just to clarify, my background's in structural engineering. So I'm a qualified structural engineer. I was trained, or I went to school in Australia, and then I went abroad, as every single 22-year-old Australian does. For some reason, we tend to travel the world, and I got a job working overseas in London on the 2012 Olympic Games. So I've been involved for the better part of a decade in some very high-end, large commercial projects in the order of that half a billion dollars worth as a structural engineer, but also as construction manager and project manager throughout my career. Fast forward a few years, I was backpacking, had the time of my life going around Europe after, and this is back in 2008, after I graduated in 2007. Finished my travels up. I'd spent a bit of time working on some super yachts in the south of France, working for the mega wealthy, and that's a different story in itself. And I'm sure if I ever meet any of your listeners, I can explain a little bit more over a beer. But essentially, I returned back to Australia after having a couple of years abroad. The travel bug was in me. I got another job as a civil engineer, sitting at my day job, and 25 years old, and going, what, WTF? Like, this can't be what I'm doing for the next 40 years of my life. Consuming myself with a cubicle, answering to a boss who answers to a board of directors, who I was just feeling like I was a small cog in the wheel of the corporate Australia at the time. And so when I said to myself, this can't be it. I've got more to give. I want to do more with my life, and I didn't know what that more was. I definitely had entrepreneurial aspirations, but being 25, straight out of college, a couple of years in the workforce, I didn't know really what entrepreneurial meant. But I knew I had to get some sort of my money working for me. And what I really wanted was someone just to pay me to live my life and go traveling and go surfing and do all the cool things. So that really got me opened sort of the door to a little purple book called Rich Dad Poor Dad. And I didn't know about Rich Dad Poor Dad and cash flow and, investor and the cash flow quadrant and, being an employee and self-employed and all that sort of stuff. And for any of your listeners out there who haven't actually read the book, I highly, highly recommend it. And that opened my eyes, and that was definitely the start of this journey back in 2009, where I first read this book. And I consumed, as soon as I read it, it was the penny dropped, and I was like, this is it. This is what I was meant to do. And ever since then, I have been focused on, creating cash flow for myself. And we can get into my story about how I moved to the United States. But in a nutshell, the start of it was way back in 2008, 2009, just fed up with, I'd been in the corporate world for a couple of years, but I was already fed up, and I wanted something more and wanted to give something more more meaning in my life than just being a structural engineer. So that's a little bit of my background.
Awesome. So definitely entrepreneurs tend to flock to certain asset classes. Real estate is definitely one of them because of the fact, for two reasons, I think. Number one, you can really start a real estate company as yourself. You have the potential to do it as long as you appropriately leverage other people's time and expertise, which I think that, you and I have definitely honed in. That's one of our strong skills there. So do you remember, what was your first real estate investment?
Yeah, so that was actually here in the United States, and that brings me, segues into the story of how I got to the United States, because everyone probably listening to this thinks this guy's got a weird accent. And so I moved to the United States because I fell in love with an American girl. And when I was backpacking throughout Europe, I met this girl, and we fell in love, and I moved to New York City. And this was after I'd read Rich Dad Poor Dad, but not probably about a year after I read Rich Dad Poor Dad. Was boots on the ground in New York City. I packed up my life into everything, quit my job. We moved. I moved to be with her in New York City, and I was probably 2 weeks on the ground in NYC. Hadn't got a job yet, and I was at my first real estate investing club. And I thought that Australia had some pretty incredible clubs and meetup groups, but by gosh, networking in New York City was like networking on steroids, and I was just completely taken aback by how, the fast talking New Yorkers, and I was just like, I thought to myself, I need to educate myself on US real estate investing, because I'd been educating myself for the past year on Australian real estate investing, and it's a different kettle of fish. So through that education over a period of about 6 to 12 months, I discovered very, very quickly that the United States has a great or lower barriers to entry than the Australian market, and I could go and pick up a property for like $50,000. And that's really where I got cut my teeth, was on these sort of cheap duplexes and single family properties in what I used to call a short driving distance from New York City. So this is in late 2011, early 2012. I bought my first property all cash, because coming to this country, I didn't have credit, and I couldn't go and get bank financing, and I essentially had to just do it using all cash. So I bought a duplex for $38,000 in Syracuse in upstate New York, and I actually still own that property today, but looking to sell it in the near future. So that was really where I started on my first deal. Just had to get my first deal done, because I was very much, probably like some of your listeners, analysis paralysis. I was just underwriting and reading a lot of books, but I just really needed to get that first deal done to really give myself some credibility, and say that I can do this and take that next step in my investing career.
Yeah, absolutely. And so, just a question about the state of affairs in New York. The market had pretty much collapsed at that point, and still is. A lot of people were still suffering. Were the networking events filled? Were people really gung-ho about investing in real estate, or was it that the people that were there were only the strong survived the crash kind of thing?
I think looking back on it, I was just such a newbie back in 2011, 2012 that I didn't know enough, if that makes sense. I was just like, oh, this must just be what it's like all the time. There was just a lot of people involved in real estate investing, and over the last 6 or 7 years, I've definitely learnt that real estate investing has always attracted a certain type of person. Yeah, you could argue that the people standing there in 2011, 2012 were the survivors, but you also could argue that there was a lot of influx because it'd been a couple of years since the crash, and that there was a lot of people sort of, the hawks circling the carcass, so to speak, to get their to get their feed.
Right.
So yeah.
In terms of the differences between Australia and the United States when it comes to real estate investing, what are some of the things that stand out when you kind of first realized what the market was like here and what the laws were like here?
Yeah, good question. I think the biggest thing that Australia doesn't have is cash flowing real estate in general. You've got to look at Australia like, take a New York market or a Los Angeles market where a single family property, a house that someone would want to live in an okay neighborhood would probably cost you somewhere in the order of $400,000, $500,000. That's pretty much what it's like across the entire country, and the reason that is twofold. The first thing is, Australia is a very small population compared to the United States. We only have 24 million people. The second thing is that we're landlocked because Australia is essentially a big desert, and you can only really inhabit a very small portion of our country, which is, with water, and that's really on the coast. So, if you look at Australia as a map, we probably only inhabit I think it's not even 18% of our total land mass. So with that forces up property prices around the major cities. And comparing that to the United States, where you have 400 million people, you have your New Yorks and your, San Francisco's on one end of the scale, and then you've got your Detroits on the other end, and 350 million people who need to live somewhere in between. So the biggest thing was cash flow, and that really, going back to Rich Dad Poor Dad, that's how I can develop passive income, buying a property, living off the rent, maybe not getting a ton of appreciation, but you're definitely getting that cash flow, which is what you wanted to essentially be able to leave your day job. And in the Australian market, they more focus on negatively gearing and looking for appreciation over a period of time. But I do think the Australian market is poised at some point to have a correction because, like here in America, the difference between, particularly in what I like to call tier one cities like the LAs and the New Yorks, the difference in income versus entry into the housing market is continuing to grow, and Australia has a very, very severe case of that, probably even more severe because the fact that it's across the nation, not necessarily focused on say LA or New York, and you could move to say Kansas City and pick up a house for $150,000. In Australia, it's pretty much nationwide. So I hope that answers your question.
Yeah, absolutely. So generally speaking, I typically look at deals exclusively in the United States. Every now and then I'll see something in a country like Belize. Belize has been doing very well, a lot of developments going up there. But I'm hesitant to look at those deals because I'm not familiar with the tax laws. I'm not familiar with the court system enough. I mean, I believe it's on common law, so there's some similarities there. But that's an extra component of risk for me that I'm unwilling to take. How did you overcome that, or how did you become educated enough in the American laws, tax implications, regulations in order to feel confident moving forward with some of those original purchases?
Yeah, that's a good question. The fact was that I was here on the ground, like I was boots on the ground. I was living in the United States, and I still live here today. I live in Los Angeles, and I was getting taxed like any other American. Just because I'm here.
That's how you learn the tax law.
Yeah, I was getting taxed like any other American. I had to. Part of your real estate education, obviously, is learning about the tax benefits associated with real estate. One of the major, for all your listeners out there, there's obviously 4 major benefits with real estate: cash flow, amortization, appreciation, and the fourth one is tax benefits. So understanding depreciation, understanding cost segregation, all that good stuff that comes along with real estate, I had to learn, and just understand the tax brackets. It's very similar to Australia. We have tax brackets as well. You get benefits from owning real estate. The government is not in the business of owning real estate. They're in the business of being a government. So they give benefits to people like us who do own real estate. So it's just about understanding those sort of aspects of it. In terms of the biggest hurdle I had was obviously the credit scores and stuff like that. The credit scores was not a thing is not a thing in Australia. You obviously have we have a similar system, but it's not like, you go online and you're 600 or you're 620 or you're 780 or whatever. We don't have a number associated next to us. It's just sort of the banks look at you like as if how strong you are in terms of repaying your debts. And the other thing was also understanding entity structuring. That was a big one. LLCs are very prevalent here in the United States because people like to hold their assets in LLCs to avoid litigation and stuff like that, asset protection. Something that I hadn't really learned in Australia. So learning that side of the coin or the equation was very, very important to buying my first deal. So, yeah.
Cool. So you originally started out with duplexes. Is that your major focus now, or what are you really focused on now?
Yeah, I cut my teeth on duplexes, and I saw the power of just going into these places, buying them cheap, and doing pretty basic stuff. What I thought was basic, and that was put a lick of paint in, put some fresh carpet, resurface the cabinets and stuff, and then increase the rents by maybe $60 or $80 a month. And I thought that's great. That goes straight to my bottom line. What happens if I did that over 40 units or 50 units or 100 units? And over a period of time, when I first came to the United States, I learned about multifamily. I also want to take maybe one step back and say that in Australia, multifamily on the commercial scale doesn't exist like it does here in the United States. So you can't go out and buy 50 units or a 50-unit apartment block. You could buy 50 units in Australia, but you'd be paying a lot of money. If people are familiar with what's called condos here in America, where they essentially build a building and they split it up and they sell the individual apartments to either investors or whoever. That's how the Australian market works. So I couldn't just go out and buy a large quantity or one building that had 40 or 50 units. Now I could go out and buy maybe a smaller building of maybe 4 or 6 or maybe 10 if you're lucky. But in general, the Australian market's all to do with condos. So learning multifamily when I first came here, the commercial multifamily, so anything over 5 units, was really, really powerful because I got to understand how businesses are valued, and the banks use the business as they look at the fact that you have rental income, net operating income, and if you can increase that net operating income, you can increase the value of your property. And that was really that's again another penny dropped. And I was like, that's really incredible, and so that forced me down the road willingly forced me down the road of getting into commercial multifamily. So stuff, we're buying stuff greater than 50 units in what I like to call class tier 2 cities, your Houstons, your Texases, your Kansas Cities, Phoenix, Arizona, stuff where there's good cash flow and moderate cap rates. That's what I'm currently that's what I currently invest in right now. I'm also looking in other cash flowing assets like storage units and mobile home parks, but stuff where I can value the net operating income, because if I can value the net operating income, I can directly control the value of my asset. And that's very, very important for all your listeners out there, is that, in the stock market, you have no control over the value of your money, and you're sort of betting on the fact that a business will do better, and by doing better, they will give you dividends. Well, when I own the property and I can dictate, what type of finishes I put in my apartments, and then that finishes will directly correlate to increased rent, I directly increase the NOI, and that directly increases the value of my property. And that's separate from where we are in the market cycle. So that's currently where I am and what I'm investing in right now.
Sure, and I agree with that completely. And that's I had a background investing in single family as well. And as I was exposed to, first of all, when I was going to networking events and I was interested in commercial properties, I was basically told not to pursue that because that's where the sharks hang out, basically. And as I kind of continued my career, I realized I was much more inclined to commercial for a lot of reasons. First of all, like you mentioned, it's traded on a multiple of income. It's much more like a business. There's not as much question as far as the value of the property if you actually stick to your underwriting strategies, make it the value based on income, and say what multiple of that income are you willing to pay. Another reason I like that, I'm sure you can relate to this, is that the complexities of the commercial real estate asset classes are such that the discrepancy between a really bad operator and an amazing operator becomes very significant. And what that means is you can buy properties that have low in-place income and implement strategies that are much more complicated, but still understandable, that residential properties don't have. And here's the third one that I have to throw, because I ran into this problem very early on, and I believe that you have a similar story. If you invest in properties that have values in that $30,000, $40,000, $50,000, $60,000 range, they look a lot better on paper than they do in action for many reasons. One of them, especially if it's outside of the state, which in California, we don't have properties that are that inexpensive. If you have to fly to the property one time, the cash flow for that year can be cut in half. And so when you compound all that stuff, I would much rather, AKA swim with the sharks and deal with the sophisticated individuals than deal with residential properties. Sorry for the quick monologue, but it speaks truly exactly my experience, what you're kind of touching on there.
I think you hit the nail on the head. There's a lot, and backing up just a little bit even more, one of the reasons I went into commercial real estate, and a lot of people probably listening are saying, well, how do you get started? I don't have the money. I got into syndication. I know, Hunter, you're into syndication, which is essentially just pooling investors' money together, and you go and buy a larger asset, and everyone can benefit in the cash flow. The reason I started syndication was because I saw a lot of these international investors that were struggling, paying all cash for these quote-unquote turnkey properties, and on paper, okay, it's $1,200 a month, but you're only going to have $500 in mortgage payment, and you're only going to have, there's a bit of taxes and a bit of insurance. It's like, that's great. Well, look at all the cash flow that's coming in. It's $300 a month. That's beauty on a $50,000 property. That looks great. But literally they tell you that you've got deferred maintenance. You have the fact that you're going to have your tenant may trash the place, and then when they move out, your entire cash flow for the year just to repaint the house or the interiors is going to cost you what you did in your cash flow. So you're actually your net income is zero. And so that was really a thing where I learned, cutting my teeth on those smaller stuff. Yes, I can get into it easy with my own money, but the fact is, my cash flow is eaten up very, very quickly, either with one trip out there, as you said, flying to the property, or two, that you may have a tenant that moves out, you need to spend $2,000 or $3,000, doing the place back up again because they've trashed it. So, yeah, I completely, I'm sympathetic to what you've done as well, Hunter, and the reason I started syndication was to offer international investors another platform to get in on the ground floor and essentially just benefit in the entire process, rather than taking on someone else's product that the profits are stripped out of. Hopefully I didn't get too detailed on that.
No, yeah, absolutely. And that syndicated structure also allows people to defer to sponsors' expertise. So you mentioned you're a sponsor, so you mentioned some of the markets that you look at. Why are you drawn to those particular markets?
Yeah, the reason I'm drawn to those particular markets goes a little bit back to what I was talking about earlier about the scale, right? There's the LA, Los Angeles, San Francisco's, New York's of America. Then there's the lower end stuff, the Detroits, and then you've got stuff in between, And what I like to call it is there's class one cities where your New York, your San Francisco's, your LA's. Then there's like class two or tier two cities like your Dallas, Fort Worth, your Houston, Texas's, your Phoenix, Arizona's, where there's still a big population, there's still good job growth, but you're not immediately thinking as a backpacker or as a traveler, I'm going to go visit, Dallas, Fort Worth, or I'm going to go visit Phoenix, Arizona. Typically, if you come to the United States, you're going to visit LA, you're going to visit New York, you're going to visit San Francisco. And those places, those tier two places, have what's called a capitalization rate, which is higher, or the ratio of income to property prices is higher in those states or those cities compared to LA and New York. And that means that we can cash flow better. So the reason I look at those tier two cities is because they've got good job growth, they've got good population growth. They may not, attract the biggest and the best, tourism, but they have a substantial economy where people need housing, and that's where I like to look, and why I look at those tier 2 cities, because the cap rates are moderate cap rates, what I like to call, and typically in the range of 6 to 8% market cap rates. So that's really why I like to invest outside of Los Angeles and where I live.
Definitely. Live where you want to live, invest where it makes sense.
Exactly.
Completely in line with my strategy as well. So in those markets, you mentioned you may be looking at multifamily apartments with, let's say, 50 units. Is that typically the type of size you're looking at?
Yeah, that's probably the low end. On the high end is up to 300 or 400, but again, it comes down to how much bandwidth you can, as a syndicator, how much money can you raise in one capital raise, and obviously the larger the property, the more money you need to raise. So, and given where we are in the market cycle right now, I'm trying to find a good cracking deal, as I like to say. It can be. It's a little tough. So every man and their dog are out there trying to look at multifamily, but it comes down to the operators and who can cut the mustard, so to speak, to make sure that the property actually does perform to what you say it's going to do and pay your investors a good return, and everyone benefits in the cash flow. So yeah.
So let me ask you this then. Given where we are in the market cycle, it's very challenging to find your typical 85% stabilized, it's 90% of market rents. All you got to do is raise the rents and use some leverage, and you're going to make your low teens IRR. What is the type of deal that you get an email from a broker and you just jump out of bed, you're super excited? What are some of the telltale signs that you're going to be super excited to pursue a different opportunity?
Well, first and foremost, I don't think a broker would be sending me those types of deals. Typically, those types of deals that jump out of bed for are probably off-market deals. One, but if say, for example, a broker did send it to me, I would want to, as you said, looking at around the 80 to 90% occupancy stabilized. You're wanting to see some definite bump in rents. I think the biggest one is the rental growth. To show that the market around it has got a higher rent than what the current in-place rent of that particular property is. So I definitely look for that. Obviously, billing back utilities. So if you can reduce your utilities, your expenses of a property, you're also increasing the net operating income. So if I can bill back some of the utilities to my tenants, i.e. water, gas, electricity, and the property doesn't have that in place as yet, but yet the market supports it, then that's a great opportunity to get in there and add some value to the property. So those sort of things I like to see. I also like to see become more of a stickler, as I like to say. I get on Google and I look at the area, and I do get my little guy and hover over the site. And if they don't have carports, that's another good sign that I can. I rub my hands, because carports tend to bring in additional income. And if they have additional space, also building small storage units on site is another great way to increase your revenue. And that sort of stuff that the current owner probably hasn't thought of. And that's where you can go in and add some great value to not only just increasing the rents of the individual units, but increasing the revenue by adding additional amenities that the tenants will value, and that in turn they'll pay you money for rental storage, or they may pay to keep their car in a covered carport, and that is all really, really great value add stuff and hits the bottom line.
Interesting. What would you say that some of those strategies net you on a monthly or annual basis? Let's say the carports, for example. What do you think that would? Obviously market dependent, but just give me an idea of what that would increase.
Yeah, like if say you did a very basic roof with four posts, and it sort of it was still an open side structure for your carports. You're probably looking at $25 a month per carport. Or if you happen to go to Home Depot and pick up some small storage units and put it on a concrete pad, and the city that you're investing in approved you putting on smaller structures on your property, yeah, you're probably going to rent out a 6 foot by 6 foot storage space for around, depending on the market again, $70 to $80 a month. Maybe a little less, depending. You want to be under the storage facilities in the area. But again, it goes back to the fact that my mission or what I invest in or what I try to do is create clean, safe, affordable places for people to live, and adding amenities where people value those amenities like carports, like storage facilities. That is only just going to help me, and not only does it help Hunter with the income, but it also helps with tenant retention and attracting a better type of tenant. So they're going to stay for longer, they're going to pay their rent on time, and overall, I don't have to chase people. So I'm happy, they're happy. We all can live happily together.
Awesome. Awesome. So let's do some closing questions here. I want to get some big
Sure.
picture perspectives from you. So what is a big mistake you've made in real estate, and what did you learn from it? If you haven't made any typical big mistakes, what is something you wish you had done differently, or something you learned earlier?
I think this is a great question. I always love being asked about mistakes, because you don't learn from successes, you actually learn from mistakes. In my mind, that's what. Anyway, a mistake I did make, I flipped a few houses in Philadelphia a couple of years ago when I was living in New York, and also when I was living here in Los Angeles. We didn't probably do enough research on the contractor, and that contractor really screwed us. And unfortunately, I had a very big lesson learned in flipping houses. And flipping houses is a job. You deploy a bunch of capital for a period of 12 to 18 months, and hopefully someone's going to pay you more for polished timber floors and drapes than what you put into it. Now, if the contractor ends up taking longer than what you had anticipated, and there's not enough meat on the bone, you can start losing money. And I lost some money on one deal. We actually had to fire the contractor, and he stole a bunch of materials from site. But I won't get into the details, but it ended up being very hairy. And in hindsight, on a small job like that, it's me who gets hit. Like, I'm not going to go and spend additional money to go sue the guy. I don't have that capital to do it. So it's more like you got to take the hit, move on, lesson learned, and they're all lessons at the end of the day. And yeah, if I could had my time over again, I would have not skimped on the general contractor. I would have actually paid for a better general contractor. You would have paid more for him, but the job would have been done quicker, and it would have been done on time, so it didn't drag on, and we wouldn't be having, I wouldn't hopefully have lost money that I did lose. And I didn't lose my shirt over it, but I did lose a bit of capital. But again, just always vet your team members. I think that's the biggest takeaway point to people listening out there. Get on Google, get on Bigger Pockets, and just Google the person's name, and you're gonna come up pretty quickly to find who is who's been in trouble with the law before, or who's not with the law, but who's got a bad reputation in that area. For this particular contractor, had actually moved up recently from another city, so he didn't actually have a bad reputation in my local market that I was investing in Philadelphia, but apparently he had done some stuff in Richmond, Virginia. So lesson learned. First house I flipped. And also learned that flipping houses is a job, not necessarily income generating venture.
Yeah, definitely. I can kind of add two things to there, which touched on some of our earlier points. First of all, background checks can be extremely helpful. If you're listening out there and you're considering engaging a third party, background checks, there's a company called TLO, which I use, and that has saved me before in the past. Someone very similar, actually, things in multiple states, which I may have not caught it because it wasn't actually in California at the time. And another thing, which ties it back to our conversation about syndications, you mentioned that, if you're investing in single family houses and someone screws you over $20,000, it does not make sense to pursue them. And
Yep.
Moreover, even if you do, you may not get anything from them because it's just not that much money. You have to really go after them. They may not be financially in a position to compensate you. However, swimming with the sharks, things are different in a lot of different ways. When you pool investors together, you are entering the world of securities. When you're entering the world of securities, if people do something that is fraudulent or borderline fraudulent, there can be criminal components there. And more importantly, if you're pooled together, cumulatively, you may have the financial means to pursue someone. And when you pursue them, because there's that criminal component, people tend to act much more ethically. In fact, I have been involved in an opportunity where I invested in the same operator as a personal investor, and then I invested simultaneously as a person in a syndication. And boy, did we get those quarterly reports on time in the syndication. And I had to end up cutting and taking a small loss as a personal investor because of that exact structure. So just wanted to add that in there because it spoke very clearly to the syndication structure we had earlier conversation. So,
100%. And I'll add one thing to it is if you are thinking about getting into syndications, make sure you have run the other way if they don't have a private placement memorandum. So if you ask, oh, you're raising capital and do you have a PPM involved? Have you got your lawyer to do up a PPM? They say no, then run the other way, because that's a document that outlines all the legal requirements that the operators must use. Now, admittedly, they can also fudge the PPM, but always have your third party attorney if you're an investor in these deals look it over and make sure, and don't be afraid to spend a couple of $100 to get an attorney for a couple of hours to look it over and make sure that you're protected.
Absolutely. In fact, we have an attorney. My personal securities attorney is coming on here in just a few weeks, which we're going to be definitely grilling him on some of these questions as well. So
Nice.
On the bright side of things, what are you looking forward to over the next year or two?
I'm looking forward to a lot of things, Hunter. I'm really enjoying the building out of the business. I've just I have employed a few people, a few interns that are hopefully going to come on and transition into full-time timers. Trying to learn to delegate because being, as you know, I'm sure, Hunter, you're an entrepreneur. You don't want to give the control up of your little business you're starting to someone else. So just learning to get people working for you and as a team. So really looking forward to that aspect of it. Looking forward to growing. I've got a podcast as well. Looking forward to growing that, and I'm also about to launch a book. So it's all coming together nicely. I am definitely a millennial where I want things to happen today rather than tomorrow. But I'm just enjoying the journey right now and really enjoying life. So that's really what I'm about.
Cool. So that's a good answer for today or tomorrow. Obviously, what about big picture? What are you trying to accomplish in the next 10 or 20 years?
Sure. Look, I want to try and get to a couple of thousand units at least. I definitely want to get more into the ground up construction game, and I've already been involved in it for many, many years. But in terms of actually doing deals in good, solid Class A markets, I do like ground up construction. I know it very well. It's just about finding the right opportunity and having the capital investors to go and back it. I want to definitely be involved in a few different diversifications in terms of asset classes. I want to get involved more in the storage units, and I want to continue to educate people on the benefits of just investing in real estate in general, whether it be here in the United States or somewhere else, because we're all going to have ebbs and flows, and the United States won't be as hot in a few years' time, and we'll find somewhere else to go and invest our money in. And in general, just creating financial freedom for my family and for my loved ones who can benefit from reaping the rewards and off the fruit of my labor that I've been doing for so hard for so many years right now, and will continue to do into the future.
Awesome. Well, Reed, thank you so much for coming on the program. I think that's a great note to end it on. Doing real estate, like you mentioned earlier, you meet a lot of great personalities. You're one of my favorite personalities I've come across. I always enjoy partnering with you on stuff. So thanks again for coming on.
Hey man, you're doing a great job. This is going to be a great show, and I'm really happy you've taken the initiative to take your investing career to the next level by starting a podcast. So well done, big fella.
Well, I got to say that you definitely inspired me. So I'll give you a link to your podcast will be in the description page so that investors can contact you directly if they have any questions.
Perfect.
For all you listeners out there, I hope you enjoyed this podcast as much as I did. I especially like it coming from that soothing Aussie accent. If you're interested in contacting Reed directly, feel free to shoot him an email at Reed, REED, at rsnpropertygroup.com. Or you can go to his website, rsnpropertygroup.com. You can also find his podcast by Googling Investing in the U.S., an Aussie's Guide to U.S. Real Estate, or you can find the links in the show note pages in iTunes, SoundCloud, or Stitcher. Thanks a lot.